Good morning. Welcome to Good to Know Talk series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. As always, we have James Ka on the line. James is a financial advisor at Edward Jones. He's my trusted source for information in the industry, and he's here to answer questions and offer his expertise. James, good morning. How's it going? Let's see if we can hear you. I think you're muted from what I can see. If you can.
Yes. Can you hear me?
There you are. Yep, now I can hear you.
Okay. Yeah, I'm doing well. How about yourself?
Yeah, I'm good. Yeah, I'm good.
Yeah, I know you're probably gearing up for the busy tax season, as I am, with probably around March and beginning of April, people start getting a hold of me in terms of trying to generate some last minute deductions.
Yes. Yeah, and our focus, the last several months has been on tax planning, and the past few weeks, as you know, we've gone over the new tax law, but it is tax season. The IRS officially began accepting returns yesterday. So I thought I would take today to talk about 2017 and offer some tips for the tax filing, which is happening now.
Oh, sounds like a great idea and very timely.
Thanks. So let's start with individuals. Higher education. So, the tax code provides a variety of tax incentives for families who are paying higher education costs or are repaying student loans. And you may be able to claim an American Opportunity Credit, which was formerly called the Hope Credit, or you might be able to claim the Lifetime Learning Credit. And this is for qualified tuition and related expenses for the students in your family, which could be you, your spouse, or any of your dependents. Different rules apply to each credit, and the ability to claim the credit does phase out at higher income levels. Now, if you don't qualify for the credit, you may be able to claim the tuition and fees deduction. You cannot claim this deduction if your filing status is married filing separately, or if another person can claim an exemption for you as a dependent on his tax return. And again, this deduction phases out at higher income levels. You may be able to deduct interest you pay on qualified student loans. The deduction is claimed as an adjustment to income, so you don't have to itemize your deductions on Schedule A in order to claim this deduction. And again, this deduction is also phased out at higher income levels. For charitable contributions, I know we've talked about it before, but I wanted to just mention briefly that you cannot deduct contributions made to specific individuals, political organizations, and candidates. You also are not able to deduct the value of your time or services, and you can't deduct, the cost of raffles or bingo or any type of games of chance. In order to be deductible, the contributions must be made to qualified organizations. And it's the organization that can tell you if they are qualified. And if you still don't know, there is an online tool if you go to irs.gov and you search exempt organizations, and it provides a list of all the qualified organizations. You do have to keep in mind that churches, temples, and governments are not required to apply for this exemption in order to be qualified, but they're qualified. They just won't show up on this online tool at irs.gov. Gift giving, if you gave any one person gifts valued at more than 14,000, it is necessary to report the total gift to the IRS, and you may even have to pay tax on the gift. The person who received your gift, however, does not have to report the gift to the IRS. And the person receiving the gift does not have to pay gift or income tax on its value. You make a gift when you give property, including money or the use of or income from property, without expecting to receive something of equal value in return. So if you sell something at less than its value or make an interest-free or reduced interest loan, you may be making a gift. And there are some exceptions to the tax rules on gifts. Some things that do not count against this annual limit include tuition or medical expenses that you pay directly to an educational or medical institution for someone's benefit, gifts to your spouse, gifts to a political organization, and gifts to charities. So if you are married, both you and your spouse can give separate gifts of up to the $14,000 limit to the same person without making a taxable gift. And for 2018, that limit is increased to $15,000. A common question I get during tax season has to do with dependents who file their own tax return. So if you have a teenager or college-age child who has a job, you can still claim them as a dependent. They will need to file their own tax return if they want the taxes withheld from their paycheck, if they want that refunded to them. However, it is very important on their tax return that they check off the box that says they are a dependent of another. Otherwise, your tax return will be rejected. Very important. Home office for employees. As many of you know, if you're self-employed, you may be able to take a home office deduction, but it may also be possible for employees if you use a portion of your home for the convenience of your employer. Now, you do have additional requirements in terms of documenting, but just know that as an employee, if you are working from home for the convenience of your employer, you may qualify for the home office deduction. IRA contributions. One popular tax savings outlet available to taxpayers today is the IRA. There are several options you have when deciding which type of IRA account. You may be able to take a tax deduction for the contributions to a traditional IRA, depending on whether you or your spouse, if filing jointly, are covered by an employer's pension plan and how much total income you have. Conversely, you cannot deduct Roth IRA contributions, but the earnings on a Roth IRA may be tax-free if you meet the conditions for a qualified distribution. Generally, you can contribute a percentage of your earnings for the current year or a larger catch-up contribution if you're age 50 or older. You can file your tax return claiming a traditional IRA deduction before the contribution is actually made. However, the contribution must be made by the due date of your return, not including extensions, so by April 15th. And please be sure to tell the IRA trustee that the contribution is for last year. Otherwise, the trustee may report the contribution as being for this year. And if you report the contribution on your tax return but fail to actually make the contribution, then you will have to file an amended tax return. And since I have James on the line, so James, is if a client is retired, can they still contribute to an IRA?
Yeah, great question. So a lot of my clients that are retired will ask that, and because they're looking for the tax benefits. And unfortunately, if you're not earning earned income, so whether that's W-2 or 1099, you cannot contribute to an IRA. So if it's just receiving pension or rental income, again, you won't be able to contribute unless you have proof of earned income, again, on a W-2, or, if you're a 1099 sole proprietor. So yeah, great question.
Mm. And what about their kids? Could they contribute to their kids?
Similar scenarios, that if the child, say if you're a small business owner and that you put them on payroll, or they're, helping with filing papers, making deliveries, and actually working, then you may be able to utilize that, because again, it's showing earned income. But again, if the child is not working, then you can't contribute or set up an IRA for them.
Mm-hmm.
Yeah.
Is there other vehicles, maybe more tax advantage vehicles besides contributing to an IRA?
Yeah, I think, with people that may want to invest in real estate, or a business owner that may want to have that asset a little bit more liquid, there's other vehicles to utilize. And just remember, with your Roth IRA, anything that you contribute, you won't have that 10% early withdrawal penalty, because with SEP IRAs, simple IRAs, 401ks, if you withdraw the asset prior to 59.5, there's a 10% early withdrawal penalty. But again, remember, with Roth IRA, since it's already been taxed, and it's after-tax dollars, you can obtain your principal or your basis, but anything that has earned any earnings, then you may be taxed, or you will be taxed and have that 10% early withdrawal penalty. Now, when looking at alternative methods that may be tax advantageous, there is that cash value life insurance policy, and oftentimes it's called a LIRP, so a life insurance retirement plan. And that if a business owner, if a high net worth individual is earning in excess of that amount to contribute to their Roth IRA, they can use a cash value policy that will be a little bit more flexible, because say if they're planning for, their children's education, whether it's for middle school, high school, college, braces, LASIK eye surgery, or even just vacation, there's no rules or penalties if you tap into a cash value life insurance policy. So I definitely recommend to sit down with Janine, and if this may seem like a good fit for you or any loved ones or coworkers, I can give some input, because there are some considerations that you want to keep in mind, and you just want to be sure to set things up based on your time frame and kind of the tax advantages and considerations that come into play.
Yeah, there's definitely a lot more options out there besides just the traditional IRA that usually comes up during tax season. So that's really good.
Yeah, and I think, one thing to recognize is that an IRA is a type of investment account. So I think some people, that may not have a financial advisor, they say, hey, James, I have this Roth IRA investment, like it's an actual investment. No, it's just the container or the vehicle in which stocks, bonds, and mutual funds are put into. So, you just need to realize that, oh, you know what, I want to have my traditional IRA invested with the same risk as my Roth IRA. They can be invested the same way. It's, again, just the vehicles in which you're investing in, and then just how it's going to be taxed on the front end or the back end. So that's one thing that I think, fairly new investors ask, is that they look at an IRA as the actual investment. No, it's just the vehicle in which you can invest into. And, what you already also want to realize is that with an IRA, there's no guarantees. So depending upon how it's invested and how the market fluctuates, the value of that account will fluctuate as well. And then if you're using something like a cash value life insurance policy, the death benefits will be guaranteed as long as you're paying in premiums, But again, that cash value will fluctuate based on, market volatility. So, with an IRA, it's probably going to be more cost efficient or cost effective because you're just investing in the market. And if you pass away, whatever beneficiaries are going to get is that market value of your investments versus, say, a life insurance policy that if you pay in, say, $2,000 worth of premium over 2 years and you pass away, there's going to be a lot more death benefit or benefit to your beneficiary if you do pass away. So it's just considerations to keep in mind. So it's not, one size fits all. It really depends on what the goals are of that specific client.
Yeah, thanks for that clarification. That reminds me, during tax season, I have clients who, usually new clients who are often surprised or don't realize that they have capital gains, until they see their brokerage statements. And, they do get the better tax rate for the capital gains. But, I do tell them that that's something that they could be made aware of. So if they were working with you, James, they could actually ask you right before the end of the year to get an idea if they're expecting any type of gains or significant losses.
Yeah, great point. So what I'll try to do, and it's a little bit difficult now since the market's performing extremely well, but any stocks that have accrued any losses, that we can sell those to use that as a tax deduction. So great point. But again, it's a little bit more difficult nowadays to pick and choose which investment has accrued any losses because, the market's done extremely well. But one question that I had for you is, I think, you hear horror stories and, there's people that I'm sure you hear radio ads, people acting like they're Hiko, saying that you have to pay your bill. But do you get it from clients very often if they're concerned about people calling them, claiming to be their IRS? And what are some guidelines to dealing with those types of calls?
Yes, there's definitely a lot more scams going around. And just a few things to keep in mind that the IRS will not initiate contact by email or text or social media. They will not demand immediate payment using a specific method, such as a debit or credit card. If you were to make any payments to the IRS, you're always going to make it to the U.S. Treasury. And another way to tell whether it really is the IRS or a scam is that the IRS will not demand you pay taxes without the chance to question or even appeal the amount you owe. So the IRS will always advise you of your rights as a taxpayer. And probably the most important thing to remember is that the IRS will not threaten to bring in the police or revoke your driver's license or your business license. So if you're really not sure, definitely do not give them any type of financial information and call me to see if this is a legitimate contact. But yeah, generally the IRS will not, initiate any type of contact by phone or email. They usually send you a letter first, so you'll get that in the mail.
Got it.
That's a common concern these days, and it's happening a lot more often.
Okay, good to know.
Yeah. And I did want to mention real quick, just a couple little known tips or deductions for businesses. One is the organizational and startup costs. So expenses incurred before a business begins operations are usually not allowed as a current deduction, and you actually have to amortize it over a period of 180 months. However, you can elect to deduct up to $5,000 of business startup and $5,000 of organizational costs that are incurred before the business begins its operations. So if you did any type of market research, meetings, travel, you can deduct up to $5,000 of these startup expenses. Another deduction that is only good for 2017 because 2018 it does expire. It's this domestic production deduction. If your business is engaged in a production activity in the U.S., you may be able to take this deduction. And some of the activities that are considered qualified includes manufacturing based in the U.S., selling, leasing, or licensing items that have been manufactured here, construction services in the U.S., which include building and renovation of residential and commercial properties, engineering and architectural services relating to a U.S.-based construction project, and software development in the US, including the development of video games. So if you have a business that falls into any of these categories and you're not looking at this deduction, you could be missing out on a valuable tax break for 2017. Unfortunately, with the new tax law, 2018, it does go away. Filing deadlines, I just want to mention for, Forms 1099 for all businesses, they are due tomorrow, January 31st. For partnerships, which is Form 1065, your tax returns are due March 15th. Previously, it was April 15th, but last year they moved it up a month, so it's now due March 15th. If you file as an S Corp and you file Form 1120S, your tax return deadline is also March 15th. If you are a C corporation, however, and you file Form 1120, your tax return is due April 15th. And lastly, for individuals filing Form 1040, the tax deadline this year is April 17th. And the reason for that is the 15th falls on a Sunday, and Monday is a holiday in Washington, D.C. So we actually have until Tuesday, the 17th, to get all the tax returns filed. But keep in mind that the tax is still due, even if you file an extension. I want to encourage everyone to get their 2017 tax returns filed as soon as possible. Why? Because then you can start planning for 2018. Everything we spoke about, today really is looking backwards. You have to have already incurred the expense in order to take the deduction. And this is tax compliance. This is recording history. So when I talk about tax planning, it's knowing all of this stuff ahead of time so you can, really make smart financial decisions. Before we finish, I just wanted to open it up if there was any other questions about this tax season. No, I don't. Okay. If you need help filing your taxes, please feel free to reach out to me, info@smarttaxhawaii.com. If you already have a preparer who's filing your tax return and you just want to talk about the new tax law or just do some tax planning for 2018, please feel free to reach out to us at info@smarttaxhawaii.com and set up a meeting. James, did you have anything else to add?
No, I thought those are all very, again, timely, kind of timely tidbits that people need to kind of be aware of. And again, just make life easier on yourself, your tax professional, and also your financial advisor. In that, you know, Janine or myself, we're proactively contacting clients so they don't miss out on any tax deduction or, you know, any type of timely tax opportunity. So it's not really anything that, you know, we lose sleep at night because it's not going to be coming out of our pockets for, you know, those tax dollars. So just know that, you know, being proactive about it and developing a plan is kind of going to be the best route. And then I think next week, if there's any listeners that are looking to either save for education for their grandkids or their children, myself and Janine are going to be discussing various options, you know, regarding education saving strategy, because I think a lot of times that people, you know, are working out of debt, whether it's student loans or credit cards, because they haven't planned accordingly to provide funding for education. So it's going to be something that's going to be very important for everyone to consider if they have kids or grandkids.
Yeah, and you know, that's a hot topic because I know financial aid applications for you know, for the high schools are due I think it's February 15th, so it's coming up real quick. So yeah, it's definitely a topic that I've already been approached by several of my clients.
Got it.
Yeah. All right, well, we are at the end of our time today. If we you know, if you would like any more information about, you know, what we talked about today, please send us an email, and we're happy to answer your questions. Thanks, James, always for your expertise. And we look forward to next week, same time, same place. Have a great week, everyone.